Thanks for joining us this afternoon, folks. Hi, Kate, Alex, David, and Amy. Um, so my intent here is to provide a way of thinking about saving and budgeting as you start your first jobs. Anything that you specifically want to focus on or any questions that you have, I think are going to be great to focus on. In that way, we can do things that are going to be the most helpful for you folks. So feel free to chime in at any time, and happy to answer any questions. Okay, so let's start off by telling you a little bit about myself. So my name's Ricardo Robles Jr. I'm a native Houstonian, but a first-generation American and also a first-generation graduate. I did grow up low income. As comes with part of this journey, there was a lot of conversations I did not have with my parents. And what I'm hoping to do here today is bridge some of that financial awareness that I didn't get by discussing things with my parents. Using that personal experience, I hope to help folks like yourself. My current role right now, I work with McKinsey & Company. I'm an associate there, so work in management consulting. I attended MIT from 2005 to 2009, majored in course 16, that's Aero Astro. And I also have an MBA from the University of Texas that I graduated from in 2020. Anything about my background you folks are curious about? Okay, all right, let's dive right in. So a few topics that we're going to discuss today. The first is budgeting, then we'll talk a little bit about financial goals, also get into some of the details around paycheck deductions. I know the first time I ever got a paycheck, there were a lot of deductions that I was kind of curious about how they worked and what they were. And then also a little overview on saving and investing. We do have another financial awareness webinar that's going to be held in the near future that will go into asset allocation. So, picking what you invest in, stocks, bonds, those sorts of things. I'm not going to get into that level of detail, but give you a high level overview around some different vehicles that are available to you and how to think about investing. Then at the end, I do have some links for helpful resources. These are resources that I'm not paid to promote or anything. I've just found them. I find them very helpful. I just want to share them with you folks. So the first thing that we want to talk about is the purpose behind a budget. Why do you need a budget? The first thing I would say is that it's very easy to be unintentional with your money. It's two very different situations, coming to the end of the month and not knowing where your money went, as opposed to lining out the month ahead of you and deciding where you're going to put your money. So allocating that money and telling that money where it's going to go, as opposed to not knowing where it's going and then seeing the after effects. When you take that intentional mindset of directing your money, that's how you can really achieve your financial goals. Depending on your situation, it could be a number of things. It could be owning a home, your first home potentially, getting out of any undesired debt. Maybe you have some school loans, maybe you have some car loans, other things like that, and you want to minimize the amount of debt that you have. It could be funding education that you're starting. I graduated in 2009 from MIT. I went to grad school in 2018. So funding some education with some cash flow that I had at that time was something I was interested in. Don't forget about the fun stuff. You may also want to go on vacation. I think it's a very important thing to balance saving for the future and then also living life today with some of the resources available to you. So intentionally planning about how much you'll put aside for vacation is a good use of your money, I would say. And then finally, a very important thing, but very long-term thing, is preparing for and appropriately funding your retirement. All these things being said, I think the final thing that we're trying to get to when we think about budgeting and deciding where our money is going to go is getting peace of mind. Any questions on budgeting in general before we get into some of the other topics? Okay. So the first step, I'll call it step 0 for building a budget, is defining your goal. So we talked about on the prior page, the different sorts of goals that you may have. Here, it could be something like investing for retirement, getting out of debt. Maybe you now have a family and you need to save for kids' college, those kinds of things. But defining the immediate goal that you're trying to achieve with your budget, that is the first step 0. Here, let's start after you've defined that goal by calculating and understanding what your net income is. We're going to, in a few pages, go over the difference between your gross income and your net income. But for budgeting purposes, that net income is where we're going to start all of our conversations. The first thing that I would recommend once you have that net income figure, what is your actual take-home pay today, is to think about your monthly expenditures and then categorize them as something that's fixed or variable, and whether they're one-time or recurring. So you need to understand on a month-to-month basis which of your expenses are going to continue to occur. Then once you have that baseline of what are the things that you're going to continue to spend money on month by month, define what your spending and saving targets are going to be. This is where, when you've defined your variable portions of your expenses, it really comes in handy, because now you can say, okay, maybe my rent isn't variable, at least for the next year while you're under a lease or something like that. But other things maybe the amount that you decide to eat out, maybe the amount that you spend on gifts or other things. But here, now you can say, okay, this is the portion of my budget that I can impact by making different decisions, as opposed to the portion of my budget that needs to stay fixed. Once you have that broken down and you know where you're going to allocate your money, then it's important to stick to your plan. Once you've identified that plan of deciding where that money is going to go, stick to it. It's really important, once you've defined that plan, to come back to that plan at regular intervals, whether that be monthly, quarterly, every 6 months, to, one, make sure that it's still working for you, two, that it's sensible and it's something that you can maintain, and then three, think about adjusting it if necessary. When you come back in a month, maybe you realize that there actually is a little wiggle room in there, and you want to allocate a little more of your budget towards a certain part. Maybe you realize that you can dedicate a little more of your income towards vacations. Maybe you realize that you can pay down debt faster. Whatever that ends up being, make sure that you come back, assess that, and then replan what your budget is going to be. When we think about your financial goals, whatever that overarching goal of the plan is going to be, I have a few key things that you should focus on. The first is to be specific. You want to avoid very general ideas like get out of debt and focus on the very specific, tangible things that you're going to do. Here, instead of get out of debt, you may say something like pay $100 above your minimum monthly car payment. The second statement there is very specific. It's tangible. You know exactly what you're going to do. Another example would be someone just saying that I want to save for retirement. How much are you saving? In what manner are you saving? Compare save for retirement to saying I want to automatically contribute 15% of my pay to my 401k. Very specific, tells us a percentage and the vehicle that we're using to save. So one, be specific. Two, also be realistic. You want to make sure that whatever dollar amount you're contributing, percentage of your income you're contributing, and any timeframes you may be deciding on, that they're realistic and reasonable so that you can actually achieve them. You may want to stretch yourself a little bit, but at the end of the day, if it's something that you cannot actually achieve, even by stretching, there's no hope there. You want to make sure that those goals are something that are truly attainable. And then the last piece here, I would say, be flexible with those goals as well. Here, I think a good analogy would be dieting. People can have a great diet, they can stick to it for a long time, but then eventually people usually fall off of their diet plan. That's normal. That happens. Things don't always go as planned, but you need to get back onto the plan, right? One bad meal does not ruin a diet. One extra expense does not ruin a budget. If things don't go as planned, maybe you need to reassess and decide where you're going to allocate your money. Potentially you realign that goal, or maybe you say this was a one-time thing, plan is still okay. But go back and realize that sometimes you don't have 100% adherence to your plan. That's okay, but get back on track. I think it's very important with all these things being said, that when you're being specific, when you have your realistic goals and some of that flexibility that you allow yourself, that I would say in your budget, you should intentionally plan to have some money that's just for enjoyment, your fun fund, whatever you want to call it. If you have a certain amount that you're allowing yourself to have fun with, I think that makes the budget, the plan, much more realistic and attainable, something you can actually achieve. That's how you avoid that burnout and discouragement. The first recommendation I would make when you're thinking about your fund and where you're allocating your money is thinking about an emergency fund. So before we're talking about getting out of debt, before we're talking about funding grad school or funding children's education, I think the emergency fund is the first thing that you should make sure is set up. The purpose of the emergency fund is to protect you from any unforeseen events that will happen, right? They may not happen in the next 3 months, they may not happen in the next year, but life can be long and things happen. The kinds of things that you want to make sure you have some cash on hand in order to deal with, if necessary, are going to be medical expenses, any sort of vehicle breakdown. If you're in a home and you're responsible for maintenance, home repair. I remember a few years ago, I had to repair the AC unit in my home. Actually, this was a replacement, not a repair. So a full AC unit, and that ended up costing $5,000. Now, I had an emergency fund and I was able to pay for that repair without having to rely on credit, but that's because I had that emergency fund there for those kinds of events. A common rule of thumb that you'll hear is to have somewhere between 3 and 6 months of your living expenses. You know, go back to the budget you made earlier on about what your fixed and variable expenses are. You want to make sure that you can cover somewhere around 3 to 6 of those, 3 to 6 months worth of those in cash, so that if something horrible happens, you lose your job, whatever situation, you have that as a safety net to provide you some flexibility in event you lose your job or whatever happens like that. This is something that is variable. You can increase or decrease this amount. It does involve risk. So keep in mind that this is a personal decision you're making regarding how risk tolerant you are and what sorts of events you want to be able to plan for. If you're talking about someone who's been employed for a number of years, one scenario that I've seen is people build a larger cushion because one thing they're interested in doing is becoming an entrepreneur. They're starting a business, but they want that cushion there just because they're not sure how much income they'll be able to generate through the business immediately, so that they can live off these savings while they're trying to build the business. That kind of situation, being an entrepreneur, carries a certain amount of risk with it. That's why in those situations, they wanted a little more of an emergency fund to be able to deal with. One goal I would say, if saving sufficient funds to provide the cash you would need for 3 to 6 months of expenses seems very daunting. A small goal that you can use to start the process would be to have $1,000 in your savings account available at any time you need. I think $1,000 is a little more manageable, and it can give you a greater sense of security. So now let's talk about gross income and the difference between gross income and your take-home pay. If you've already started your first job, you may have received a contract that says, hey, here's your salary. This is what your pay is going to be. Obviously, whatever that contract says is not what your paycheck is actually going to be when it's deposited into your account. When you think about gross income, that's typically what your employment contract says, but that's the total pay for your job that you're going to get before taxes are taken out and other deductions. Common deductions that you'll see in your paycheck are going to be federal and state income taxes. Federal taxes in the United States are progressive. So the more income you make, the more you pay in taxes. State income taxes are, varied. They're going to vary state by state. If you don't have state income taxes, states usually have some sort of property tax or some other way of collecting revenue for state budgets. But state income may be something that's deducted from your paycheck. You'll also have Social Security deductions. Social Security is something that is paid jointly by both the employee and the employer. So if you're an employee who gets a W-2, 6.2% of all of your wages, up to a total of $142,800 as of 2021. This is something that changes as inflation increases salary levels. But 6.2% of your wages are then also deducted to account for Social Security payments. If you're someone who's self-employed, keep in mind that someone who's self-employed is now responsible for both for the employee and employer portion. So now they're responsible for 12.4% of Social Security taxes. There's also a separate Medicare tax. That's going to be a tax of 1.45% on your earnings. This tax has no limit, so it's not only taxed on the first $142,000 that you earn, it's taxed on every dollar that you earn. And there's actually an additional surtax, an additional 0.9% for any income above $200,000 per year. Final deductions that you may see on your paycheck are going to be there's a lot of various deductions that can happen, but the most common ones are going to be your health insurance, your dental insurance, and obviously that's going to vary depending on what your employer has set up as available plans, and in some cases, the plan you select. Let's say your employer has different choices available for health insurance, then that's probably going to affect the premium that you pay. The important thing to keep in mind is that health and dental insurance is deducted pre-tax. So that means anything that you have to pay for those benefits, they're taken out of your paycheck before the taxes are assessed on your earnings. Once you look at your top line, the gross pay, and take away all those deductions, you go from gross income minus deductions, finally to net income. That net income is what many people call take-home pay. That's what you'll actually see in your account. And like I mentioned before, that's going to be the starting point for your budget, right? That's the baseline that you start for all of your budgeting analysis. Any questions on what we've covered so far? Okay, so let's talk about a sample budget and some common categories that you may see. Here, the first thing that I would focus on would be your residence. Whether we're talking about owning a home, renting an apartment, any option like that, a common rule of thumb that you'll hear that I will also personally advocate for is that no more than 30% of your net income goes towards your primary residence. In some cases, depending on where you live and the role that you have, you may be pushed one direction or the other. Depending on your income level, it may make more sense to rent with roommates as opposed to purchasing a home and having that ownership responsibility. But still, I would advocate for that rule of thumb that you spend no more than 30% of your net income on where you live. Let's also talk about transportation. If I hope in a post-COVID world that more of us are driving around and having to go into offices. But when we think about transportation, whether it's owning a car, public transport, renting a scooter, whatever it is, another rule of thumb here would be to spend no more than 15% of your gross income on whatever your transportation method is. If you're doing Uber, keep an eye on what that Uber tally is at the end of the month and make sure that you're not spending more of your income than you would intentionally like to on getting around. Also think about utilities. Whether you're renting or owning your home, you likely will be responsible for the utilities here. These are going to be things like your light bill, electricity, gas, water, internet, those sorts of things. Obviously, that's going to be very location dependent. And in some cases, it's going to vary based on the plan. There's lots of different internet service providers, lots of different plans you can select. So that's going to impact how much you spend there. But keep in mind that you will need to have those as recurring expenses. So something that you need to keep in mind for your monthly budget. Next category here is going to be food. We have to eat. We're not like plants. We can't run off of sunlight. So think about how much you're going to spend on groceries and restaurants. One thing I keep in mind when I think about where I'm spending my money on food is, I like to eat food that's either good for me or good tasting. So whether you're getting your groceries from HEB, which I don't know, they're only in Texas, so maybe that doesn't resonate with a lot of people, but I'm from Texas. We love our HEBs. Whether you're going to a grocery store or you're going to a restaurant, don't only get tasty things, but also think about from a health perspective, what are you doing with the food that you're purchasing? Your greens, vegetables, lean meats, those kinds of things. Make sure that you're purchasing things that are nourishing for your body, not just junk. It's not just a matter of how much you're spending on the food, but also are you getting the right food and the right nutrients for your body? Second point that I'll make on food is that even from personal experience, I will say that eating out adds up fast. I remember the first year or so after I had my first job after college, that I was really shocked at how much money I was spending eating out. It's incredibly easy, especially if you have a pretty vibrant social circle, to go out with friends every once in a while. Once or twice a week can turn into several $100s per month, $1,000 per month if you're really excessive. But that's something that can have a really big impact on your budget. Not to say that that's right or wrong. If it's something that is providing you satisfaction and you want to spend that money there, totally fine. But just make sure that you're being intentional with that spending. The last category that I'll talk about here is your saving and investing category. Now, this is the last category, but very, very important. A rule of thumb that I'll advocate for here is to target saving somewhere between 10 and 15% of your income. When I say 10 to 15%, I'm also including any employer match that you may have from any benefits you get from your job. If you have a 401k match up to 6%, include that in your goal of saving 10 to 15% of your income. If you have some sort of HSA option that your employer partially funds, include that in the percentage calculation. But I do think it's a good rule of thumb to save somewhere between 10 and 15%. I don't have the exact numbers worked out here, but saving between 10 to 15% for 38 working years, in most cases with a reasonable asset allocation and retirement plans, can more than adequately fund a retirement. So do keep in mind that when you're thinking about saving that money, it's not just about not having access to that money today. It's about funding the retirement that you'll need in the future. When we think about saving and investing for retirement, the first thing I want to mention here is the top three concerns that people tend to have when they think about retirement. So in order of the concerns that most people have, the number one concern is not having enough money for retirement. The second most concern is not being able to pay medical costs. And then the third most significant concern is not being able to maintain the standard of living that a person had while they were still working. All of these can be addressed by appropriately saving and investing for retirement, and also having a plan for how you're going to achieve your financial goals. Here, when we think about the way that you'll fund retirement, the first thing I would examine is your employer-sponsored plan. These are going to be things like 401ks, HSAs. In some cases, you'll also see Roth IRAs. There's a whole variety of investment vehicles that different employers provide. Whatever they are, get some detailed information from them. I can't provide you all of the information here, but in most cases, these vehicles are going to provide some tax-free way of saving towards your retirement. Most traditional plans, so most 401ks, HSAs, those sorts of things are done on a pre-tax basis. So you take money out of your paycheck, you don't pay taxes on that money, and you can invest it in that vehicle. There are a few other options though. In one case, a traditional IRA is one where you can actually pay taxes immediately, pay your taxes today, invest the money post-taxes, and then you don't have to pay any taxes when you withdraw that money. That's a vehicle that's also available through a Roth IRA. A Roth IRA is something where the gains are tax-free, and they can give you an advantage compared to something like a 401k. So again, if we look at a 401k, you invest your money before taxes, you invest it in an account, it can gain capital over time. And then when you're retired and you start withdrawing money from that 401k, you have to pay taxes at that time as you withdraw the money from the 401k. Compare that to a Roth IRA where you can invest the money Post-tax, so you've already paid taxes on that income, you invest the money in a Roth IRA. It can gain capital over time, but when you withdraw that money, there's no taxes to be paid. This is a tax-advantaged account, and there are IRS regulations specifically written for the tax benefit of an IRA. With all of the tax benefits you get, there are a few limitations. You can't invest more than $6,000 per year in a Roth IRA, and above a certain income level, you can't contribute to and get the tax advantage of that Roth IRA. If you look at a traditional 401k, that also has a limit. You can't contribute all of your income to a 401k and pay no taxes. But 401ks have a limit that's considerably higher. That limit is going to be $19,500 as of this year. This is something that typically every year has a certain amount of adjustment where it increases. When you think about all these investment options as well, this is a place where I'll recommend you do quite a bit of research to make sure you understand the tax ramifications and the options available to you. You may also want to consider speaking to a financial professional. Depending on how knowledgeable and how savvy you are, how comfortable you are making these decisions on your own, you can choose either one of those options. One thing that I would keep in mind when you're evaluating all of these plans as well is the employer match. I mentioned earlier that when you want to save and invest for retirement, your goal should be 10 to 15% of your income, but you should include whatever employer match is available to you. To a certain extent, you should consider that money free money. A common way that 401k plans are structured by employers is that your employer will match you up to a certain amount of your income. I've seen some plans where you can invest up to 6%, and every percentage point of your income that you invest in your 401k, your employer matches. In other words, if you put in 3%, your employer puts in 3%. If you put in 6%, your employer also puts in 6%. And then they have a cap typically. In those situations, if your employer is matching you, consider the employer match part of your saving goal. If your goal is to save 10%, you put in 5%, your employer also puts in 5%, you've hit your 10% goal. I would also say that as much as is possible, you should try and maximize whatever the employer match is. If you're not maximizing that employer match, you're leaving money on the table, money that could be very useful for you in the future. It's free. You just have to make sure that you're investing in order to make sure that you get that employer match. Let's see. An important thing, the final note here, when we think about saving and investing for retirement, in our cases, as folks who are on the younger side, we're talking about saving and investing with very long time horizons in mind. Typically, these retirement accounts are structured and set up in ways where there are penalties if you withdraw that money before you're 59 and a half years old. The intent of these vehicles and the reason that they have these tax advantages is because the incentive is to appropriately fund your retirement. They have the carrots to help you fund. They also have the sticks if you try and dig back into those funds. So we're talking about very long time frames. And the main thing that I will recommend to folks when they think about investing for retirement is that the time you're in the market matters so much more than trying to time the market. Trying to buy low and sell high as if you're an active trader in the long term is not as effective as just buying on a predictable schedule and letting that money stay in your account. To that end, I have an example here. If we were to look at two students who graduated from college at the age of 22, let's set up some context here. Let's say that one student invests $10,000 per year from age 22 to 32 and then stops contributing. Let's say that she earns an average of 7% per year over her entire life. At age 65, she's going to have $1.28 million in that account. Let's look at another example here. Let's say that someone else doesn't start investing until age 32, but they invest the same amount, $10,000 per year, and they do so for the next 33 years. So student A invested for 10 years at the beginning of her career. Student B waited to do other things and started investing and continued to do so until retirement. Student B earned the same amount. On average, they got 7% per year over their entire life. At age 65, graduate B is only going to have $1.19 million. This illustrates the power that compounding can have on your retirement accounts. Investing early and letting the money stay there can have really, really substantial impact on what your retirement portfolio looks like. And that's why I say time in the market, getting that money in there and letting it stay there is much more important than trying to time the market. When we think about saving and investing, other than for retirement, there's two main ways that I would think about this. The first is in your short term. The second is in your medium term, right? Retirement's going to be that long-term saving method. So between short and medium term, there's a few different goals you may have. Things like a down payment for a house, education, vehicle, other things we've talked about. And there's going to be a few options you have for saving either in the short term or medium term. Here's just a few options that are available. High yield savings accounts. These have the advantage that they're very liquid. They have low risk, and they tend to have low returns, right? There is a relationship between the amount of risk you take and the amount of returns you get. In order to get returns, you need to take some risk. That doesn't mean you should take risk with all of your money, but in this case, these high yield savings accounts tend to be low risk, and they give you some moderate amount of return. In this case, think about not losing money and not losing purchasing power due to inflation. In many cases, these high yield savings accounts also have insurance coverage up to, I think it's $200,000 now, just like a bank savings account would. Another option will be bank CDs, certificate of deposit. These have what we'll call moderate liquidity. Typically, you'll have a contract that you sign where you're agreeing to give a bank or some other institution total control over some amount of money for a specified period of time. It can be 3 months, 6 months. They have various terms on these certificates of deposits. And typically, the amount of return you get is related to how long you give up control of the money. You'll get better returns in CDs than you will in a savings account. But again, it's something where you have to make sure that you do not need the money in the CD for whatever period of time you agree on the CD. As an example, you could sign a one-year contract with the bank. Maybe they'll pay you 2% on the funds in the certificate of deposit. Over the course of the year, you get 2% payments on your deposit. And then at the end of the year, they return the principal to you. You get that initial investment back. You can reinvest it in a CD, you can move it somewhere else, but that's the way a CD would work. And then finally, the last option I'll talk about here are going to be your individual brokerage accounts. Individual brokerage accounts can be provided by many different types of companies. Here are some examples: Fidelity, Vanguard, Charles Schwab. These types of accounts are not tax advantaged. So these are the investment vehicles that you would select once you've maximized all of those tax advantage accounts. But they are a way that you can continue to direct some of your income towards investments. So again, not tax-free, and you can choose between a variety of investments. Okay, give me 1 sec, folks. So the last thing that I want to focus on here is staying on track. I mentioned this earlier, where you need to have a plan, but it's also important to realize that you're not likely to stick to your plan all the time. You want to stay on track as much as possible. There's 2 main methods that you can do this with. The first is going to be active management, where you're doing everything yourself. You have some kind of spreadsheet or a log that you maintain yourself. The other is going to be more passive, where you rely on a service that does this for you. This is going to be something like personalcapital.com or mint.com. But these services, typically they'll link to your account, so you can link them to your checking and savings account or other vehicles. I'm not saying there's a right or wrong option here. The best option and the best strategy is probably going to be a combination of the two and according to whatever your personal preferences are. Last page here is just some helpful resources that I have for you folks. NerdWallet is a website that can provide you some useful financial information. NerdWallet was also founded by ex-MIT graduates, so a little bit of nerd pride there. I also have a link here to the IRS form for your W-4. The W-4 is what you use to control how much your tax deductions on your paychecks are. Typically, if you go with the default tax deductions, it's not going to be right according to what your income is. So you may need to adjust them in some way, either additional withholding or less withholding, especially if you're someone who is married filing jointly and both spouses are working. Typically, you'll need to adjust your tax withholdings to make sure that you don't owe additional taxes at the end of the year. But this link here is where you would go for the W-4. And then finally, Credit Karma is a free resource that can provide you information on your credit score. Available for free. They do have some advertisements for credit cards and things like that, but they do provide you helpful information on your credit score. But that is all I had for you folks. Give me 1 sec. I need to make a call. And I'm back, folks. So here, I'm just going to open up the floor. If anyone has any specific questions, anything they want to focus on, everything's up for discussion. Feel free to chime in if you'd like. Okay, I know one thing I'll say after the fact, on this page here, I highlighted some of the differences that you may see between two people, one who invests early and another one that takes a delayed start. In my experience, very analytical people, especially people like us, tend to get caught up in trying to maximize what our returns are going to be over a certain period of time. They get worried about picking the right stocks, making sure that they're in the right sort of investment vehicle. Now, that has an impact. I don't want to say that it does not have an impact, but honestly, 80% of the results are going to be achieved just by doing something. Deciding to invest, taking a portion of your income and dedicating that to saving and investing is going to be responsible for the vast majority of your results. The little tweaks that you make on where you decide to invest and how you invest specifically, think of that as the gravy, right? It's small changes at the end of the day. Don't let your concern about maximizing whatever your strategy is get in the way of achieving most of the results. That's the final thing that I'll leave folks with. And let's see, I'll check the chat to see if there are any questions. And no questions. Awesome. If there's anything else, feel free to shout out now. But other than that, that's all the content I had for you folks. Thanks for dialing in tonight.